Welcome to Momentum Monday. Today is July 3rd, 2022. Happy 4th of July weekend, Howard.
Yes.
What's new?
Not much. What do you do in Bulgaria for 4th of July?
How do you know where I am? You have no idea.
No, I mean, what do Bulgarians do?
Oh, probably nothing. It's a Monday. So just a regular July summer day.
Is there warm weather in the summer in Bulgaria?
Oh, I mean, this summer is especially warm. They say it's like in the 90s. So it's much warmer than usual.
Wow, it's the 90s in Bulgaria. All right.
Oh,
Where are you today? San Diego with me?
I'm in San Diego, yeah.
All right, buddy. How did I do on our run?
I think you did pretty well. It was a short run, but yeah, you did well. You're in really good shape, Howard.
Thank you. Thank you.
Not just for your age, just in general. You're in good shape.
I'm hurting today. I've been working out with a trainer on weights. Whew.
Good job.
All right, take us through this hellhole that is the market.
Yeah. So, I mean, just judging by the price action in the market, I think the market is discounting potential recession later in the year, just because look at the stocks, the groups they're actually outperforming. Like we're having all of a sudden utilities, consumer staples, like stocks that tend to do well during recession because people cannot really change their spending habits. Those stocks are outperforming, like pharmaceuticals, Eli Lilly and Merck, auto parts like AutoZone, educational stocks like Stride, General Mills.
What? Stride, huh? Oh, General Mills. What does the monthly look like on that?
Yeah, this is new all-time highs. So when you see those types of stocks, like typically lower beta consumer staples, utility stocks leading, the market expects economic slowdown, potentially a recession later in the future.
Mm-hmm.
So this is exactly what we're seeing. These are the current leaders, and no bull market starts with those types of stock being the leaders.
Yeah.
So
yeah, they look good for a little bit. I mean, I will say that it's kind of sad, but you can just see the regime here with defense stocks, Northrop, NOC, Lockheed Martin.
Yeah, those definitely jumped on the news that the US will have a permanent station in Poland. Definitely we saw NOC, the LMT, the MRCY, like those jumped on that news. Kind of working on new basis, I guess, in a way.
I'm gonna I'm gonna look at these things. God damn it, that's just gross. But I mean, our weapons in the Ukraine are keeping the Russians, I guess, somewhat at bay. But
yeah, all of those stocks basically, I think they rallied ahead of Russia invading. So I mean.
So not all of them are kicking butt, but the big ones.
Yeah, definitely.
Big ones tied to the government.
So I mean, outside of that, like the kind of two industries groups that are standing out are China and biotech.
Okay.
And let me pull up KWeb. I mean, just like most high growth stocks kind of topped in February of last year. Like February was the height. And since then, the KWeb, the Chinese internet ETF, went down 80%. So in 1 year, so February 21 to...
That's the index.
Yeah, that's the ETF to March.
Imagine like freaking
80%.
ITV dropping 80%.
Yeah, in 1 year. And it seems like it bottomed in March. And since then, it made a few higher lows. And it's moving high. I mean, obviously on a weekly it doesn't look amazing. But if you look at
what people want to buy in a U.S. recession, God bless them. A rigged Chinese market.
Yes, and if we're talking just
that's what we're talking about in July of 2022. That's how bad it is in the United States growth that we're talking about a rigged.
These are the stocks that are acting
No, I
constructively
know, I
right
know.
now.
It's really pathetic.
So that's why I'm mentioning them. So if you go through like at least like 10
Biotech. Let's flip to biotech.
biotech, yeah. So biotech is the other one that, if you look at the weekly, they also topped in February of last year.
Wow. Yeah.
And from there they had like a 65% drop in the next like year and a half, which is a pretty substantial drop. It's bigger than the drop in 2008. Maybe you have to go all the way to 2000, 2002 when that ETF didn't even exist to see this level of decline.
Yeah, I mean,
And
they've rallied 25%. They're still like 40% below
the 52-week high, but it's even
no,
more
between
than
the 200-day.
more than from February, yeah.
Wow.
And definitely starting to act constructively. A lot of interesting setups in the sector. 80 is a big technical level here. So if it manages to go above 80 and kind of test it successfully and stay above it, it has a chance to go to test its 200-day near 100. So that's what's going on basically on the long side.
Yeah, but we can agree that like, all right, that's for nimble traders. But I mean,
yes.
But let's just take a look at semiconductors.
Yeah, that absolutely got
just
demolished. Yeah.
But I mean, this is as bad as I can. I just can't say anything nice about growth, right? And now you have the truth setting in. Like, I mean, there's a company like, let's pull up Zendesk, for example. Okay, it was never cheap. Okay, so let's go to the monthly. But this is like a $10 billion leading, and I mean, again, it's only probably 12 years old, 13 years old, but this was like AAA, customer support help desk software. Obviously, law of large numbers eventually took it effect, but they turned down a $17 billion. I think they just got taken over. Now go back to the daily. They got taken over at 10 billion here, or private equity, sorry, which is a good sign. We need private equity to work. But this stock was at all-time highs a year ago and agreed to a take under or takeover, whatever we're going to call it, at a $10 billion. They agreed to a takeover with $1.5 billion in the bank and cash flow positive. And they turned down a $17 billion offer last year and agreed to a $10 billion offer, I don't know, 8 months later. So this is a leader. Okay, this is a company that's not struggling, that is willing to be taking our private equity down 60% from last year. Okay, so I don't know what people are drinking, but this is the data point that you have to watch. This is a company that was cash flow positive. They were still losing money. The cash flow positive with $1 billion change in the bank, and growing 20-30%, and they sold for 7 or 8 times sales. This should give you a hint. If you can't read the tea leaves and go, everything's still massively overvalued, and your only hope is private equity for a 20% pop, like if you're still looking in tech stuff, if you're still looking for signs that there's a bottom in growth, this is the best signal you got. We're not in good shape, okay? Because this is a leader. So this should put a cap on a lot of stuff for a very long time in enterprise software. Yeah, it's great that there's private equity out there, but what is your upside if you're bottom fishing here? It's not much, okay? Because your best shot is hoping for private equity to come in here. So the other big thing that's going to come home to roost, and a lot of people are talking about this, at least in the corp dev side and the software side, is that these companies, even if they're cash flow positive, they're diluting the companies every year by giving stock-based compensation out. And so this is going to come home to roost to NASDAQ stocks as well from the last 10 years, is that even if they're profitable, they're diluting you by giving out shares every year to employees. So you have a double whammy going on. A lot of companies aren't making money, like the Twitters of the world, and they're diluting you 2 to 4% a year if you're a shareholder. So we could go so much lower in valuations because what the market's telling you is to get profitable. Like, and a lot of companies just aren't listening. I think about a company that, you know, is a seed investor in Robinhood. Let's pull it up. And the market is saying, get profitable, and they still have 3,000 employees. Like, you know, so no one's listening because they haven't been through this before. Even look at Cloudflare, right? One of the leading, you know, I own it, but like they're just not listening. These companies are being yelled at to show that you're profitable, which means growth at reasonable cost. Like they still want growth, but you got to do it in a profitable way. And I don't think young management teams have been through this. And they may say, fuck Wall Street, but there's a lot more pain to come because you can't just fire 8%. You know, I think the markets are demanding you fire 30%. And I'm not saying every company should listen to the market. I'm just saying this can go on for a long time while money flows to alternatives. So you've got rates rising, Ivan. So there's an alternative there. And then you have debt, which people can do debt on a lot of these growth companies. So I just don't see how tech, my worry is I just don't, you know, I'm a one-trick pony. And so I continue to carry high cash because I don't think the growth companies realize how much trouble we're in. You know, inflation's still what, 9%. Oil's still over 100, I think. Yeah.
Yeah, but it's pulling back. Oil stocks, natural gas, both of them.
The stocks are pulling back, but oil isn't.
But oil stocks are like 20-30%
Who cares
haircut
about oil
in the
stocks?
past.
What
Yeah,
matters to the economy is that oil would drop. That doesn't change the price at the pump. That energy stocks are
yeah,
pulling back. The energy stocks are pulling back because of the bear market, finally, and everything's
yeah,
coming. So commodity prices still, the commodity stocks may be rolling over, but the most important commodity, oil, is staying above 100.
yeah. But
And, you know, we're in the heat of summer right now, but, you know, fall in Europe will get cold. And fall in the US will start getting cold. So these things are not being dealt with. And nor is the war, I don't know what you're hearing in Bulgaria or your family's hearing, but like what the war ain't ending.
yeah, it's not ending anytime soon, and
Yeah.
seems Russians are advancing.
Yeah.
Yeah,
So macro wise, even though I'm not a macro person, you have to be blind to the fact, like you don't have to be a macro thinker to finally realize rising interest rates, high energy prices, a Fed that has basically said, bring on famine, bring on a recession, we're going to battle inflation. And it's not like they're hinting those things. And then you have, you know, overvalued growth even after a 50% decline in this type of market. So it's a tough, I would just say, you know, happy 4th of July, but like be really careful. When I see the semis like just not having a bid, you know, that's scary. And as much as biotech in China is getting a bid, they're, you know, they're cash burning, the biotechs are cash burning behemoths.
yeah,
And like what you just said, Ivan, you're not going to get a bull market with General Mills and Eli Lilly
no,
breaking out. So you're not going to miss anything. And, you know, being 100% invested in a bear market, you know, an extra 20, 30% drop in your portfolio is not pleasant at this point. Makes getting your money back that much harder. So I know a lot of people are revenge investing down 25% this year. But you need a better tape. Is there anything that you like? Are you just high cash still? I mean, we've been talking about this now.
yeah. I mean, I'm high cash, but I'm also taking the occasional short-term swings and intraday, like in biotech in China, just small size, just to
If we saw a 20% rally, I think you would be looking more at swing shorts than you would long.
Yeah, exactly. If we have a 20% rally, it just depends on the type of setups I see in the market currently. The most constructively looking stocks are just consumer staple, defensive stocks that they're not true leaders. So
Yeah.
if we see more leadership in high growth names, then
Yeah.
obviously I'll become more bullish, and I'll hold longer with bigger position size. The silver lining is that, eventually this is going to end. It could be like a few months from now. It could be like 6-7 months. And this,
The macro conditions don't have to change though, Ivan. The war can get worse. Oil prices can stay elevated because,
yeah,
and rents, we haven't factored in the fact that rent prices are bananas.
yeah,
Now, there is incredible amount of employment opportunities out there. People need to get back to work. So there is right now, from what I read, a lot of opportunities, right? Like if you want to work, you can work. Okay. But if people are on the treadmill working to stay, to continue to be in negative deficit, that's a problem, right? So I just think defense, well, we've been saying this, I don't know, since December, but defense is offense right here.
yeah, absolutely, yeah.
Yeah.
I mean, you're right that, it's better.
I haven't seen anything like this
and to
since 08. And we weren't doing this, but we were friends back then. And tech looks like the financials did in 08, like Amex. So you'd wake up and it would just, went from 100 to $8. This is
I
American
know.
Express, right? Forgetting like Citibank and Goldman Sachs. I just remember, unfortunately. I remember buying Amex down 70 in the 30s and I went to 8. I'm like, what?
What was the symbol for this? I forgot.
AXP. AXP.
Okay.
So go back to the monthly. You look at that.
I mean, it was
I was in that
special situation.
I think I started buying that at 24, and I was so happy to like trade my way out of it. Obviously, much like just so happy. I couldn't have predicted that was the bottom, and we wouldn't look back. And I'm not saying Amex is going to 8. I'm just saying that's what tech stocks look like right now. That's what China did last year. What Amex did.
Yeah, exactly.
So it's not like that that these were bad companies or tech stocks are bad companies. It's just there's other stuff going on, and these companies were built with stock-based compensation and diluting the shareholder base and the market, the what you call it, but like what Wall Street wants is now completely different than what they wanted during QE. You know what I mean? And it's just going to be a really tough market. No,
Well, eventually,
but again, like there's opportunities, but I like for growth, I don't know.
Yeah. Okay. Let's take the worst case scenario. Let's assume that the next 15 years will be flat for the indices, for the S&P 500. I mean, even if this is the case, which is the worst case scenario,
it'll be great bull market runs. Yeah.
I mean, even if like the passive index will be dead for the next 10-15 years, and you have to be an active investor to do well, you still have good opportunities during that time. You still have like shorter term, bull market rallies that might last only 6 months or a year. There'll still be growth stocks that will do well eventually in the next decade.
Yeah, I'm just saying, right where we're at right now, bounces are really possible, of course, and wouldn't be even surprised to see one, but I also wouldn't be surprised to see a complete meltdown because,
But that's an opportunity. That's a great opportunity for people that are prepared.
The other thing that's important is, and this rarely happens, is credit spreads are widening. I don't have a chart for it.
In the junk sphere, definitely, yeah.
And this is always a sign of impending trouble. Doesn't mean that we're not in it, and it could be credit spreads could start narrowing again, but they generally, that's my dog, it really loves credit spreads.
Yeah, she's long some junk bonds, so she doesn't like it, yeah.
So with credit spreads widening, it's just another factor. And then the other factor is U.S. Much as we can make fun of the Fed, they are, even though they're behind, they are acting. Europe is like still in denial of this and so far behind. So we can bail ourselves out, but for growth, you know, we've already lost China and Russia. Now we could lose, you know, the Europe because they're just so screwed up
Yeah.
and organized. So it's very hard for growth. Again, like you said, the S&P's got lots of sectors, but the QQQs just may be dead for a while. Like the S&P at least is a diversified sector of industries, and you know. But anyways, that's how I feel this week. I think the odds are very stacked against anything but short-term bounces, and I think really sophisticated, you know, traders like yourself that look at markets are hoping for a rally so they can get on the other side of this. And but obviously, you know, we see some sort of crash, there are going to be buyers. There's lots of cash out there. So if you see the S&P in the 3,000 area, a lot of people will step up. But at 4,000, you know, it just feels like the risk reward is still, you know, high cash.
Well, we might be another like what 20% away from another QE. Like currently in Europe, they're even talking about another QE, just using a different.
But you know how
name.
silly that does sound, right? Like
Yeah.
it you know, you and I could trade around through it, but eventually fundamentals, as much as it was fun not to think about them for, I don't know, 15 years, 13 years, this could be a market that starts caring about fundamentals. But I hope I'm wrong. Literally, this would be awesome if I was completely wrong. But it seems like all the calls I make, no one seems to understand that there's like a major change going on. And if you look at what private equity companies are doing, like what they're buying and where they're willing to buy stocks, there's still a lot more downside. The good news is private equity has flush with cash, and they will come in and wring out the excess. So what they'll go in to do at Zendesk, pull that up again, is so they raised 10 billion. They probably put up 2 billion. They raised 7 or 8 in debt or 9 in debt. So their return's going to come off 2 billion, right? They don't have to like double their money. So they're going to try and turn 2 into 4, 2 into 3 over 5 years, right? For 40, 50% return. There's a million ways for them to do that, right? And what people have to understand is they are around. They're just not going to pay market prices for stuff in a bear market. And the problem with private equity, if that goes away, is interest rates continue to rise. They can't borrow at that 0% interest. So there is a world where the private equity guys disappear, not because they have no cash, just because the math doesn't make sense. So again, prices would keep dropping. So rates are a real important factor in all this. So it's very complicated. Like the macro didn't matter, and now it just matters, you know? So
Yeah.
it's just my old man yelling at the computer screen rant for the day.
Good.
All right.
All right. Let's finish with that. Do you have
Happy
anything
Fourth.
anything
Happy
cheerful
Fourth.
to say?
Don't if you're gonna light a firecracker in the house, because Ivan's done that before. Just be really careful. And have a good Fourth, everybody. Ivan, see you this week.
Yeah. See you, Howard.